Welcome to the Mortgage Minute podcast, where we talk about how to buy a house and save money at the same time. Follow us on Instagram at the Mortgage Minute, and don't forget to like, comment, and subscribe to the channel. If you have any comments, questions, or concerns, please email us at info.mortgageminute@gmail.com, and we will feature you in the next episode. Hello, and we're back with Isaiah Ramos, real estate agent here in the RGV. Great to have you here today, Isaiah.
Thank you very much, Mr. Frank. It's definitely a pleasure to be present here with you and, of course, discuss and dive into these further details regarding financing.
Great. So let's dive into it real quick. I know Isaiah's got some fourplexes listed over in the Mission area. You want to tell us a little bit about those properties, Isaiah?
Yes, so these fourplexes are situated in a pretty nice location right across from a school, actually, a primary school. So it's great for families who have little kids who are getting ready for primary school. But in addition to that, it's a pretty good location because it's pretty close to Conway and Mile 3 as well. So you're going to be situated between a lot of superstores, restaurants, a lot of good amenities that Mission, Texas has to offer. And the good thing about these properties or these fourplexes, they're competitively priced in the low 500s to
Wow,
524, 900, más o menos.
that sounds great.
And in addition to that, they're able to qualify for an FHA loan. And it is not all the time that a fourplex is able to qualify for this FHA loan, which I
Great.
think is really cool.
Yeah, so let me talk a little bit about that since I'm on the financing side. So we can offer FHA financing of 3.5% down payment on a fourplex like this one. And the great thing about that is that you get to use the other three rentals. So you get to live in one of the properties, you get the other three rents from the other three units, and you're able to use that to qualify for the mortgage. So in that rent, pretty much from the three other units, pretty much covers a payment. So you, in essence, get to live for free at that place when you're the owner and you live in one of the units. The other thing about it, you can do also conventional financing. You can do with 5% down, or you can do VA financing for those fourplexes, and that's 100% financing with no down payment. So again, it's a great opportunity for anybody who hasn't purchased a home in the past to live in one of those fourplexes. You can live in it, rent the other three, and in essence, live rent free. Is that right?
Wow, that that is amazing. And one quick question. I know that you mentioned VA financing on fourplexes. So let's say that we have an individual who has 100% disability. Does the 0% or property taxes also apply to
That's correct.
fourplexes?
So when you're a veteran and you're a veteran and you qualify for the VA loan, and again, VA loan is 100% financing, no down payment. But if you're also a 100% disabled veteran, then there is no property taxes at all. So regardless if it's a single family or a multi-unit, as long as it's your primary home as a veteran who's 100% disabled, the here in Texas, there is no property taxes for somebody like that.
Wow. And that's on a fourplex. And I can only imagine that that is just cutting thousands of dollars off of their monthly
Oh
or
yeah,
annual, tax.
yeah. I mean, if we just use a sample of 500,000, be it a fourplex or a home, you're looking to spend about $7,000 to $8,000 worth of taxes on a yearly basis. So that's about how much you're saving. So somewhere between $600 to $700 is what you're going to be saving on a monthly basis on a $500,000 property on taxes when you're 100% disabled. That's a lot of money.
That's a lot of money. Wow. That is beautiful. And so, what I also wanted to touch base on, I know that we're sitting in this beautiful and gorgeous model home,
Hmm.
and I heard somewhere that you guys can build one right
Oh
in
yeah.
this community.
So the builder for this property is McKinney Glen Homes, and McKinney Glen Homes can build your home exactly like this one across the street for a price of about 449. I mean 439.9, and then it'll look exactly like this. It'll have the same finishes. It'll have just everything that you see is going to be included across the street. The lot is about the same size. And the good thing about across the street on the in this subdivision, by the way, we're at Atwood subdivision in Edinburgh, the corner of Hohen and Schunier, and you can come on over and look at this model across the street. We can build it, like I said, for 439.9 with taxes and insurance. I think the builder is going to help you bite down the rate also. So there's some incentives built into it. So you're going to be able to get into probably below 6%, probably somewhere in the fives is where you're going to be able to get into that interest rate with the incentives that the builder has to buy down the rate down for you.
Wow. And what do you think that would be looking like on a monthly basis?
Monthly basis, with taxes and insurance, you're somewhere around 35 to $3,600 a month, with taxes and insurance, depending on where your credit stands. But in an FHA loan, that's what you're looking at more or less. A quick tip also about new construction. A new construction, since it's a new construction, you're able to, for the first months of the year when you own it, your payments are going to be based on unimproved taxes. Why? Because it takes the county, I mean, a while to catch up with what's been built or what hasn't been built, and then start taxing both lot and home together. And so that goes for the first few months of your payments are going to be a lot less based on just lot taxes. Eventually, that's what the payment is going to be down the road. But for the first few months, you kind of get a break because the taxes will be based on just lot taxes only.
Wow. And quick question for you. If somebody wanted to build this home on their own unimproved lot,
Yeah, we can certainly do that, and so we can do that. The builder is willing to. We can do a two-time close, and I even offer a one-time closing. A one-time close is where you offer the interim construction loan, the construction loan, and permanent financing all rolled into one. And so that's a great money saver for people, per se, because they're saving themselves a one set of the closing costs. And so if you wanted to build this home on your own lot, this home right now comes in at 375. 375 for construction without the lot. So 375 just the way you see it, and we can build it on your lot. Um, we can do that as well.
and you guys build anywhere in Hidalgo County, right?
Anywhere in Hidalgo County, yeah. Edinburgh, McAllen, Mission,
Mm.
Flor, San Juan, Alamo, yeah. Anywhere in the Hidalgo County area, we'll be able to build this house for you. Like I said, for 375, just the way you see it, with all its amenities, all the detail that it has, everything that you see, we'll be able to build for you for 375.
375. That's a really good deal.
That's a really good deal. And then the builder, like I said, they also come with a 1 year warranty and a 210 warranty. A 210 warranty is it's a company that they offer a special warranty to all the builders. The builders pay for it, and then they pass on that to the customer. And so a warranty is the foundation, and a warranty is the structural, which is all the framing. So if there's any kind of issues with that, you always can put a claim, just like any other insurance. And then also on top of that, the builder offers a 1 year manufacturers or worksman warranties, bumper to bumper, that pretty much covers the whole house for an entire year.
That is amazing. And that's great that you guys offer the 210 warranty because it's not very often that I run into I guess, a builder representing buyers that actually qualifies for this 210 warranty.
Yeah.
So that's always a big plus and an extra level of reassurance for the buyer.
Yeah, absolutely. Yeah, yeah. I mean, doing that, it's a big benefit to the to the customer. How the builder is able to promote that and give that to the customer. In essence, they're paying for all that cost, and the customer gets to reap all those benefits from the builder.
Absolutely. And quick question. So, what would the monthly mortgage look like? Let's say that we get somebody who's from out of town, and they wanted to buy, let's say, the house that you guys could potentially build right across for
Mm-hmm.
439,900.
Mm-hmm.
If they happen to be military, what would that be looking like?
If they were military, they're 100% disabled. I mean, military. Talk about that first.
Yes.
Let's say they're military. They qualify for 100% financing. The good thing about financing for VA, there's also no mortgage insurance. So normally on an FHA loan, or a conventional, there's going to be mortgage insurance. That's a savings of about almost $200 a month. And so when I was talking about a $3,500, $3,600 payment, then we're talking about $200 less. So that's more like a $3,300 payment with taxes and insurance when you're a VA, because automatically the mortgage insurance goes away. Now, if you were to couple that with somebody who's 100% disabled and they don't pay any taxes, well, my goodness, now you're talking about a payment that's probably sub 3,000. So below $3,000 is what you're going to be looking at on a monthly payment to pay just the principal and interest, and the insurance, because there's no taxes and there's no mortgage insurance either. So I mean, if you are a veteran who's 100% disabled, I mean, you could buy a house just like this across the street, and your payments would be under $3,000 a month.
Wow, and that is great. Now,
Yeah.
I did hear you say a few cues or something that kind of, I wanted to, I guess, inform the general audience on. When you say 100% financing on a veteran or VA loan, what exactly does that mean?
What that means, 100% finance, it means no down payment. I mean, just like you have a 3.5% down payment on FHA, this would be no down payment. Just when you talk about a 5%, 10%, or 20% down payment on a conventional loan, again, a VA loan requires zero down, no down payment. Many times, VA customers that I have in the past, they actually negotiate the closing costs with the seller or the builder, and at the end of the day, they end up coming in with nothing. And so many times these customers put up earnest money, which is normal when a transaction, let's say $1,000, 2,000, let's say it's $2,000. So since we can roll in all the closing costs, the seller is paying for all the closing costs, and it's 100% financing, they actually get those $2,000 back at closing. I think we had a transaction like that not too long ago, that the customer actually got money back at the transaction because all the closing costs were paid. It was VA and no down payment. So it's a having a VA loan. You being a veteran, please take advantage of that benefit that you have earned through your service, and use it to your advantage, so you can get into a home and have a very low payment.
That is very much enriching information that I think
Absolutely.
anybody who is in the military, if you're looking to purchase a home soon, of course, please do not hesitate to reach out to us for anything. Mr. Franks, he's got us situated.
Yeah, any questions, please get back to us. You'll see it on the comments. You'll have our information at the bottom of this podcast. So if you have any questions, please reach out to me, reach out to Isaiah. We're here to help veterans, or anybody who's not a veteran, anyone who's looking to purchase, build. We can certainly help you. Yeah, and that's correct. I mean, the way that works is the rents of the other three units are about 1250 on average. I mean, that's we do an appraisal, and when we do an appraisal, we ask for something called a rent schedule. So the rent schedule, just like you get comparables to do an appraisal, you're going to get comparables of rent. So the appraiser is going to get, for example, other fourplexes that have sold in the last 12 months in a 1 mile radius. And then not only are they going to look at what the sales price was for the fourplex, but how much rent are being generated, or how much are the rents for that particular fourplex that they're using as a comparable. And then they put that in a schedule. So this game, comparable A was this much, comparable B was this much, comparable C was this much, and then they kind of come up with an average, and they say, okay, then the market rent for your fourplex is going to be 1250, 1275. We did an appraisal on the ones that we did that are over there in Palmer Street in Mission, and back in August there were 1,250. So we actually need to do another appraisal, because now it's almost 8th of February. It'll be 6 months, so we have to order a new appraisal. So I imagine that those 1,250 are not going to be 1,250. They're probably going to be 1,300, because since August to now, I'm sure rents have actually gone up. So now you're in the price of the fourplex hasn't changed. So the price of the fourplex since August to now hasn't changed, but the rents are actually going up. And as time goes by, and that's a great thing about owning a rental property, because as the price of the what you pay for it is a price. That's not going to change. And as time goes by, where you're going to keep paying into it, so your balance is going to decrease, your value is going to increase. So that difference is called equity. And then on a rental property, because you're generating rent, that rent as time goes by is going to continue to increase. Because in August it was 1250, probably now it's going to be 1300. A year from now it might be 1400 or 1350, and every year if it increases by $50 per unit, that's an extra $150 more. But you keep decreasing your balance and your equity keeps going up. And let's say in 3 4 years from now you're like, okay, you know what, I don't want to live here anymore, I want to buy a house now. No problem. Then you keep that the same the way it is. You move out of your unit. Then you have another renter, and so now you have all 4 units rented for, let's say, $1,300 a month. And then you go buy a house, a freestanding house that is not a multifamily. You would buy that one conventional with 5% down, and no problem.
Could you also buy another fourplex?
That's a tricky situation. So whenever you have a fourplex, you could go from a fourplex to another fourplex, but it couldn't be FHA again.
Gotcha.
Why? Because that's another rule. You can only have only one FHA finance property at a time. And actually, there's a couple of situations where you can, and you can when they're more than 100 miles apart. So let's say you bought the fourplex in Mission, and now you're gonna move to Laredo and buy another fourplex in Laredo, and you wanted to buy it FHA. You could, because it's more than 100 miles away. But let's say you live in Mission and you want to buy something in Edinburgh, another fourplex, then this one would have to be conventional because you already have an FHA. Now, can you buy a conventional over here? Yes. Make it your primary home. Yes. So that becomes investment. This becomes primary. And now, as of November of last year, you can get into a conventional fourplex with 5% down.
Wait, so you can get in with a second fourplex at 5%
That is
down?
true and correct. As
Wow.
long as you don't own any other property,
Okay.
such as you own your FHA fourplex.
Yes.
That was your first one. 3.5% down payment. You own it. You live in it.
Yes.
And then a year later you say, I don't want to live here anymore. I want to buy another fourplex. Then you go to Edinburgh. You find another fourplex. Okay, I want to buy this fourplex. I want to live in it and collect the other three rents. Can I do that? Yes, but that one would have to be conventional. And that one you could do it with 5% down as of November of last year, because before that, to do a conventional fourplex, regardless if you're going to live in it or not live in it, you needed 25% down payment. But they changed the rules in November of last year.
That is
Actually, it was November the weekend of the November the 18th. And so yeah, could you buy that fourplex conventional? Yeah, you can buy another fourplex. But and you can actually, and then after that, if you wanted to buy another fourplex, you could a third one, but again, it would have to be conventional, right? Conventional 5%. But once, and I guess you could theoretically keep playing that game, but the day you buy a single family, it's over. Because the day you find a single family, and then you say, okay, now I want to go back and buy another fourplex, no, because they will not approve you moving primary home from a single family into a multifamily. They'll do it the other way around, multifamily to a single family or multifamily to multifamily, but not the other way around. So
gotcha.
in theory, you could do that up to a point where, again, there's rules to that too. You can't have more than 5 finance properties at a time. That's another little rule that's hidden out there, that you really can't have any more than 5 finance properties at one time. And so when you try to go get a sixth mortgage, they go, no, yeah. You would actually have to have one of them pay. You can have 100 properties, but only 5 can be financed at a time.
What?
Yeah.
So it's kind of like that one individual that always buys cash. What's his name? He's always advocating for don't collect any debt, pay off your properties 100%.
Right. Right. Right.
Forget his name.
Yeah.
Um,
So yeah. So that's another
Dave
little
Ramsey, yes.
that's another little rule out there that a lot of people don't know about because it's not every day you find somebody who owns 5 properties, right?
That is
And
true.
they're all financed, and then all of a sudden, like, well, I want to buy a sixth one. Yeah, it's hard to. And I've had that situation before, and I've had situation where people, I have somebody who's owns 10 rentals that are paid off, and they want to buy and want to finance another house. Yeah, that's no problem. You have 10 rentals, but they're all paid off. Okay, no problem. Yeah, we can do that. It has to, up to 5 finance properties.
That is great. And so when it comes to somebody who's looking to invest for their first, I guess, house hack, fourplex, as they begin to build equity, what about, cash out refinance do you know about?
Yeah,
Um,
yeah. So cash out refinances is if it's a primary home, which is where you live, that's called a home equity loan. So a home equity loan, or what they call an A6 loan. And why is it called an A6 loan? Because in the state constitution, there's a section uh, uh, for lending, and then it says Section A, subparagraph 6. That's why they call them A6 loans. But an A6 loan, a home equity loan, in on your primary home is a cash out or a cash out refinance. Your primary home is a home equity loan. Home equity loans are highly regulated by the state. And what does that mean? That means that not only do you have to qualify just like any other mortgage loan, there are certain fees that the borrower cannot pay for. In I'm talking about in limit. So, for example, the customer, the borrower, can pay more than 3% of the loan amount in fees. So that means that many times a borrower to be able to get a loan or to be able to do the loan or a lender to do the loan, it has to be a loan that has to be about 150,000 and up.
Gotcha.
So yeah, so $150,000 and up is really where the sweet spot is for somebody to get that home equity loan. Because if it's below that 3% rule, the fees would be higher than that 3%, and then we can't do the loan.
Gotcha.
And so, can you do home equity? Can we do home equity loans? Yes, all day long. Can we do now a cash out refinance on an investment property? Yes, we can. So,
Awesome.
for example, now we're talking about investors. So we have an investor that has a couple of properties that are already paid off, be it a fourplex or a single family. We can do 75% loan to value. So we can do 75%, well, 70% on a fourplex and 75 on a single unit. Whatever the value is, we'll pull that out and then give you that cash. And then with that cash, you can grab it and go buy a fourplex investment and put down 25% down payment if you wanted to. Yeah.
Wow.
So yeah. So you can leverage. That's what it's called. You can leverage the equity that you build in properties that are maybe paid off, because you have a property that is paid off, for example, and that's great. You can sleep good at night, but that money, that equity is not working for you. And so you can actually pull the equity out of it and grab that and buy another property that is gonna build you more income, or another revenue stream.
That is definitely very insightful
Yeah.
for an investor who's looking to take advantage of their equity,
Yeah.
I guess through a fourplex.
Yeah. Yeah. And I actually had a client just like that. He owned a home with about 10 acres and he was already paid off. He didn't live there anymore. He had bought another house and he rented that property out. So he's getting rent on a property that's paid off. Says, can I get an equity loan on this? Not a home equity because he didn't live there. Can I get a cash out on this? I said, yeah. So I gave him, I don't know, 180,000, 190,000. He continued renting it, right? Because he had the renters there. Then he grabbed those 190 and went and built from ground up a duplex. And then that duplex, he built it for about 150,000 and then rented 2 units for X amount of dollars. So now all of that he was getting rent from here, and he only had one loan.
That's really good. And
Yeah, when you start to build properties and equity,
mhm,
there's a lot of ways we can use that equity as a lender to the borrower so they can buy more properties and make even more money.
and is that cash out that they take out, is that taxable or
Yeah, yeah, it's a loan. It's a
it's a
loan.
loan? Uh-huh.
Yeah, it's a loan. It's called a cash out refi.
Mm,
When you're pulling cash out, the equity, when you're pulling the equity out of your primary home, is called a home equity loan.
yes.
And so those are a little two different terms. A lot of people get confused
Mhm.
because well, it's a cash out refinance on the primary home. Well, that's a home equity loan, and if it's a home equity loan, then all the other rules apply.
Gotcha.
Yeah,
Okay. Wow, this was very informative.
yeah, absolutely. Yeah, if you have investors out there who are have some properties and they want to buy more properties, they have equity, they have stuff that is paid off. Oh yeah, home equity loans are a great tool to buy even more properties.
That is good to know. Wow.
Absolutely.
Alrighty.
You have any questions for him? No, Isaiah, I'm just
Total real estate.
How's the real estate company? Is it getting hotter now? Is it
It's picking up right now. Of course, I've sent you a few clients,
yeah,
and I'm rotating lenders in and out,
sure.
trying to balance it out. But a good like 15 families in total, which is what I tend to work on average. But I mean, it's just helping everybody out, and people are getting their
And are you
income
getting a lot
tax.
of calls? I mean, is it are people active? I mean, you're getting a lot of calls, a lot of inquiries. That's what I mean.
Yes, especially from Canada,
Wow.
from out of the country, Mexico, just a few minutes ago.
So what's the deal with people moving into the valley from other places in the U.S.? Because I hear that a lot.
Yeah, so I've had the pleasure to represent that one client
Yeah.
who is actually still not here, but
Hmm.
based at New York. And so their main concern was just New York's just too, it's just completely changed and just overpriced. And so, just like what they say in Hawaii, a lot of people just tend to be priced out of paradise.
Sure.
And to some extent, that kind of ripples throughout the other main areas in the US. So, good instance is it's going to be families from California, New York. I mean, those are some of the states that I can
Hmm.
think off the top of my
Right.
head,
Right.
but I'm sure there's Washington,
Oh yeah. I mean,
Oregon.
just here lately, I got California, Ohio, Florida, New York, New Jersey. Yeah, Arizona. So I got into all those states, and I guess it's just an affordability issue, right? I mean, things are so much higher in those areas that they are here.
Exactly. And that is the exact kind of sentiment that I receive from these prospective clients from out of state. They just say, Isaiah, the houses that we see at the Rio Grande Valley, they're affordable. And what we can get for this price here is like a shack in the middle of nowhere.
Wow.
And I told them, hey, you know what? McAllen is the fifth largest metro. People love to live here because although it is the fifth largest metro, it is a very nice paced area. We have really good school districts. Affordability is definitely here. And this is the new hidden gem.
Yeah. And from the financing side, it after COVID, a lot of people are working remote. So a lot of these folks who who live in I just remember Philadelphia was the other city, who are living in these other cities, and they just can't afford to live there, but they can actually continue working for wherever they work and actually move down here and keep that remote job that is a good paying job and able to afford this stuff. And as long as you're a remote worker, well, you can live wherever you want. So you can be coming from Philadelphia and live here with no problem because you have a remote job. Being a remote job, you can do it from anywhere. And so, for example, I had two clients from California. They were from San Diego. Their jobs are completely remote. I have another one from Philadelphia. She works for the city of Philadelphia, but she can do it remotely. I had another client that does IT work in from Austin, and we haven't even talked about Texas, but from Austin, who works for the city of Austin, and they work remotely. And so
Wow.
even just sort of up the road from here, Austin area, which has become very unaffordable because of high prices, people are moving down here because they can work remotely for whatever company they work for, and live here and still get paid from over there, but live here. So it's a win-win for all those people who are remote workers who live in other states and want to live down here and actually, build equity and buy a home. I had a client from New York, and I said, "Mr. Client, why are you buying a house in Texas when you live in New York?" And he simply said, "If I stay here, I'll never be able to afford a home ever." I said, "Wow, it was kind of sad, but it was true because he said I will never be able to afford a home." And the guy made good money. It's just that there was no way that his salary was going to be able to cover a price or a home in the New York area, and so he moved down
Yeah.
here.
Yeah. And that's how it is. And actually, that's a great question to just kind of segue into. What would be your first set of questions to ask somebody if they're relocating to the Rio
Yeah.
Grande Valley, somewhere pretty far away? What would be some important things for them to?
Yeah. So main thing is, for the financing side is
Mm,
equity. I mean, job stability or job history. And are they going to be moving? Are they going to be transferring? Somebody who's in the medical field, that's pretty easy. They're a nurse or a physician's assistant in California, in Ohio. They can easily get a job down here in the RGV at one of the hospitals. That's an easy thing. Or so it's always about, okay, are you going to relocate? That's great. What do you do for a living, and how are you going to continue doing that here versus over there? Well, I'm going to get transferred. Here's my transfer letter. Or I am going to get a job. I work at a hospital now. I'm going to get a job at the hospital down there. I have one client who's already, he is a nurse, and he's already, because nurses have to be licensed just like PAs and doctors. And so this gentleman's already put in the application to switch his license from Ohio to Texas to be a nurse. And so I said, "Oh, that's fantastic." And so that's kind of those are the questions. Is like, so are you get are you going to get transferred? Are you going to get a new job? And in what fields are going to be the same field, or how easy are you going to be able to do that? And then, of course, if you're a remote worker, and if you're a remote worker, great. Well, then nothing changes, because whatever you've been doing for the past, let's say, 2 years, you're going to continue doing it just from a different location. And at that point, all we need is a letter or an email sometimes from their supervisor saying, "Yeah, Mister So and So can work remotely. Thank you." And that's all I need. I grab that email, their pay stubs or W-2s, even though they're from Philadelphia, and that's good enough. I qualify them. The next thing you know, they're here in 30 days and moving into a house or a
wow.
fourplex.
And what would you advise, somebody who's young? What kind of credit score would you be looking at,
Yeah,
or debt to income ratio? What exactly makes
yeah,
someone qualifiable?
yeah. Somebody who's young, and two things that first time home buyers or young professionals need to work on is job history and credit score. So somebody in job history just means we need to have a 2 year history as a rule of thumb. But the two job history can include schooling. So, for example, you went to school for 4 years to be a nurse. Now you're a nurse, but you only been a nurse for 6 months. Can we use that income as you being a nurse? Yes, absolutely. Because now we have 4 years of schooling, 6 months of being a nurse, all in the same field. And so that would qualify you. It's a 2 year history of a combination of work and school, as long as it was on the same field. You're a welder and you're 19 years old or 20 years old, but you work in the oil fields, you're a welder because you became a welder in high school. Now, a lot of high schools now have special programs for trades where when you graduate with some kind of certificate. It could be spreadsheets, it could be welding, plumbing, electrician, whatever. And so what do? I said, okay, well, did you graduate? I said, yeah, I just graduated, 2 years ago. Okay, that's great. Did you take, take some classes for welding? Yes, I did. Did you get a certificate? Yes, here it is. So I get a transcript from the high school. I get the certificate. And then they've been working for 6, 7 months in the oil fields doing welding. Can I count that? Absolutely can. No
What?
problem.
Wait, so people can actually use
Mhm.
their prior education. So you're saying that they don't need a full 2 years
Yeah.
of strict work history.
Yeah, no, it doesn't. It has to be. It can be a combination of school and work. Now, if you've been working for 6 months in a field that you didn't go to school for, so then yeah, we got a problem. Now that you got to get a 2 year history there. But if you had schooling here and you're doing that for a living now, then I take the whole thing. I'll give you an example. So I had a client who 2 years ago she was uh she was working in a nursing home. While she was working at the nursing home, she was going to nursing school. She was going to nursing school. She did about a year and a half of nursing school. And then she says, you know what? I don't want to do this anymore. I want to be a truck driver. This lady from New Hampshire. She says, I want to be a truck driver. So what did she do? She went to truck driving school. She went to truck driving school for about 6 months. And she was still in the nursing. And then she got out. And then she went to work for a trucking company. And she had worked at the trucking company for about a year, year and a half. So I was able to take the year and a half there, the 6 months of schooling, and then mind you, before that trucking school, before that she had nursing experience. But I was able to, because I had the 2 year of schooling for trucking and her driving, I was able to get all that squared away, and we closed that loan. And I
Wow.
used her income as a truck driver. In 2 years prior, she was working at a nursing home, but she had a change in career. But what she did, what was smart, was that she went to school for it. The schooling part is the key. So whenever you change careers, there's going to be some schooling in there in between. That's the key to make it sort of work. Because if you don't have the schooling and you're like, well, I was a nurse this year, now I'm a truck driver. Well, wait a minute. Did you go to school for it? No, I didn't. Well, then now we got to wait for you to be a truck driver for 2 years because you have to have that, be in that field. Oh, no, I went to school. Okay. Well, great. Then we can use that. And so we closed that loan with no problem. We just have to get the right documentation.
Wow.
There's
Finance hacks with Mr. Frank.
So yeah, I mean, there's a lot of ways we can qualify people, and the more information that I have, and the more I'm able to talk to somebody, the more I'm able to come up with solutions. Because sometimes, like I say, always say, we solve problems that people don't even know they have.
That is true.
Yep.
Yeah. Yeah, because and that's why it's always important to for a prospective, investor or home buyer to just disclose everything as
Yeah.
detailed as possible.
Ever
So
tell me everything, because I'm the one who's gonna figure out what to do, where to go, what to do. The other thing that young buyers, young professional, it's credit score. So, what's a good credit score? Anything above a 620 is all right. You can get a loan. Always people ask me, well, what's the lowest credit score you can work with? Well, FHA has a rule about 580. So, the lowest credit score you can get on FHA is a 580, but that one you have to put like 10% down. You have to have money in the bank. You have to have reserves, things of that sort. Anything above a 600, you would qualify with that reserves or a higher down payment. So I would say, 600, but really you should start working to getting a 620 credit score. And then how do you know you have a credit score? What credit score you have? Well, you can always go to creditscore.com. You can go to karma.com. It's not going to be as accurate as it would be as me pulling a credit report for you, because there's different types of credit scores. We could talk about that later, but I'm going to just say there's 7 different versions of a credit score depending on what the credit score is for. So if it's a job, is one credit score. If it's a rent, is another credit score. If it's a car, if it's for school, if it's for a mortgage, if it's for a credit card. There's depending on the what the purpose of the credit report is for, it's going to determine your credit score. So a credit score for a mortgage is not the same thing as a consumer credit report for you as a consumer that you pull it from, say, Credit Karma. That's why many times people say, I say, well, what's your credit score? Have you checked your Credit Karma? Says, oh yeah, it's a 720. Great. Then I go pull it and it's a 690. Like, why? And then they say, well, you dropped me 30 points because you pulled my credit report. No, that's not the way it works. The reason why there's a difference is because what you see, Mr. Customer, Mr. Consumer, is a consumer credit report. Nobody's going to make a decision on lending you based on that. That's for you. What I pull, I'm going to make a decision on if I'm going to lend you money or not on this credit report. So this credit report is a different type of, the way they analyze it is a different way than if it was just for you. So this is kind of for show and this is for work. And so that's why there's a difference in the credit score. Not because I pull your credit report, it dropped 30 points. And that's not the way it works.
Wow. Wow. And I know that there's a few clients that have expressed like, hey, Isaiah, if I'm about to submit an application, will it drop my credit score by a whole bunch?
Yeah. No, and really that's kind of a myth. Those are called inquiries. So when somebody pulls a credit report on you, it's called an inquiry. Does that lower your credit score? Yes, but when there is a many inquiries pulled in a short period of time. But what does that mean? How does that mean many? So, for example, you go somewhere, you apply for credit, and they pull your credit report 10, 12 times in one day. Yeah, that's going to lower your credit score
Dramatically?
dramatically.
Oh,
At least 10, 15, 20 points. You go next week and you go apply again and they pull your credit report another 10, 15 times. Ooh. So within a 7-day period, they pull your credit report 25 times. Yeah, that's going to lower your credit score. So when people ask me that question, then I ask, when was the last time you pulled your credit report? Then they say, oh, it was 3 months ago. Oh, okay, there's no problem. If you pull your credit report 3 months ago and then I'm going to pull it now, it's not going to have a bearing on your credit score. Don't worry about it.
that's good to
It's
know.
something that, yeah. So credit scores get dropped on inquiries when there's a lot of inquiries in a short period of time.
That's good to know. Wow.
Yeah.
All right. Any other questions, Mr. Frank?
I don't know. Any other questions, Paul?
Ask away.
Ask away.
Talk about yourselves. Talk about how you
Talk
came.
about me? I don't want to talk about me. I talk a lot already.
How did you get into real estate?
How do I like Isaiah? Oh, we all love Isaiah.
Is it how?
We,
how
we,
did
we
you
have
get?
a picture of Isaiah at the office. Go, oh, Isaiah. Oh, they love Isaiah.
So, Mr. Paul, to answer your question, how did I get into real estate? Well, first off, over
Oh, yeah.
two
Tell
and
them
a
that
half
story.
years ago, I at no point did I think that I was even going to do real estate. I actually got my degree in biology, and
But it's not just biology. It's like, what is it? It's like,
it's biological sciences with a minor in chemistry. Now, later down the road, I did pursue a graduate program, but before I did that, I actually relocated to San Antonio so that way I could work at the job that I was accepted for, which was at Fort Sam Houston. And I love to boast that I got a top secret clearance because I didn't know how hard that process was until I finally got accepted into the job. But basically, I was going to become a research assistant for a military base. And then COVID happened. And so, whenever COVID happened, they just told me, Isaiah, well, we got you're accepted into the job, but the base is closed for the next, well, we don't know how
who
many,
knows how long?
who knows how long. And so I was in limbo
And
with
you were bags packed and everything, right?
and lease under my name.
And you're about to go. You got the U-Haul going. You got it all wrapped, packed to go, and they go, never mind.
Never mind. We never took the next step to get me started and in the military base. And so I said, I mean, I have to pay the bill somehow. And
Correct.
so at the meantime, I was studying to get my real estate license and I did it in like a month. month and a half. I moved as quickly as I possibly could, so that way I could at least, try paying the bills. And so thankfully I got my real estate license and I started off in apartment locating. And it was a hustle. And so over time, apartment locating, I did good in it. I had the support of my family, my cousins, and but it weeded me out actually. I stopped doing real estate for a good minute because I said I do not want to do apartment locating again. It's so much volume and it's a lot of work. And I'm talking about leasing 20 plus apartment units. It's a
And did you
lot.
do that here locally or somewhere else?
It was at San
In
Antonio.
San Antonio. Okay.
Yes, and Austin, Texas. And so it was a bit overwhelming, and that was a taste of reality for me because for the longest time, like every college student, you're used to just sitting down here at the desk, listening to Mr. or Mrs. Professor just telling you, hey, study this and you'll pass. But this was a really big reality check for me. Lo and behold, a few months later, or I think a year later, I decided to come back to my roots, which is the Rio Grande Valley. And I decided to pursue a graduate program because I felt that as though I was still in limbo. I had no idea what I wanted to do. And so I got into graduate school for biochemistry and molecular biology, and I was killing it. I'm really good at school, but I didn't see myself doing it long term. And then I was doing real estate and graduate school at the same time. It was a lot of work, but then I realized that the fruits of my labor were really, I could see it in real estate because it turned into, a closing,
Things started to
and
pay off.
then it started to pay off, and I was just looking at the dividends that my hard work was reaping. And so I just said, you know what? I love school and all, and the school let me down. I am just going to do real estate now. This has been the only thing that has showed me that it is my calling.
So let me ask you. So before real estate, while going to school, did you have any other jobs before that?
I did, yes. So actually, I did door to door sales with a water softening company.
Oh wow. Okay.
And I lasted a good few months. But then that's when I decided to move back to the valley. And then whenever I was here, I was actually working for a pretty big law firm here in the
Oh
RGV as a legal assistant.
oh
And
wow. I
so
didn't know that.
yes, I worked for a pretty big law firm, and then I just did that before school started. I got accepted into the graduate program. Meanwhile, at
Wow.
the graduate program, I was a research assistant, teaching assistant, graduate student, and then doing real estate. So it was pretty fun. I loved it, but eventually I just kind of fell out of love of the academics and found my true passion in real estate.
Wow.
So
So did you ever work at Whataburger or anything like that or no?
I did. So back in before well during college, I worked like three jobs like in my 4 year college
Yeah.
years. And so I was working at Ross as a loss prevention officer, and then I was working what was that second job? It's been a good while. But that second job, what was it's they were all oh, I was working at the library. So I was a library assistant at the university, and then I got promoted to a higher library assistant, but at the School of Medicine. And so I was working those two jobs. And then the third job was more like a side hustle. I would
Mm.
create, candies or and do icicles and just go to parks and sell them. Really good profit. and, so, and, so, and
Okay,
so
well, I mean, I'm trying to get at because you. It sounds like you've always been a hustler, you know, right? So you got three jobs during college.
uh,
You knocked on doors for water shop because that door to door, sales. That's not easy,
uh,
and so you were really hustling, and that was all really setting you up for what you're doing now.
yeah, and it really does help a bunch because all of that has given me the experience to make sure to follow up,
Hmm.
to give someone the due diligence, just kind of reaching out, and just making sure that they're okay. Just following up, talking to people, and answering any questions. And even when I don't know the answer to questions, it's like, hey, well,
Let me get it.
let me get that for you, and
Absolutely.
and I'll answer it as soon as I possibly can. Or you know what, let's set up a meeting with the lender, or let me get you connected with the lender, and I'd rather you hear it from the horse's mouth without me giving you misinformation.
Absolutely.
So you gather all that experience and just kind of apply it into life, and it's all
And here
resulted
you
in
are,
this. Yeah.
and you're doing well.
Yes, sir. No, by God's grace, yes. And now I got to meet you, and
Yeah.
man,
I mean,
it's been
and I
great.
was just going back through my own calendar. We actually had lunch for the very first time that I met you on January the 6th of last
January
year.
the
So I've
6th.
known you for just a little bit over a year.
Wow.
Yeah, and we've done a bunch of deals, and we got relationships going, and I mean, things are just flourishing everywhere. So anyway, it's been great.
It's been good, and but it's been a blessing, and
Yeah,
so to be a part of all this,
absolutely.
working with you,
Mhm.
McKinney Glen, and
Absolutely.
then getting to meet new people such as
Yeah,
Mr.
every,
Paul here.
every day. Yeah, Paul is on the other side of the camera. He's the one
He's a
running
cat.
all the tech today.
Yeah,
All
all
right.
right.
Anything else? Closing?
Close it off. All right.
Well, that's all we got for you today. I'm glad that Isaiah Ramos was here today, real estate agent here in the RGV. It was a pleasure having you here with us today. I'm so glad you were here and you were able to share all your experience and all your knowledge with us.
Absolutely. And especially you too. We definitely, myself, and of course, the audience out there has learned a whole bunch about financing.
Absolutely.
And
Anytime. And we'll continue doing this, Look out for more episodes in the months to come having to do with other topics because we can talk about real estate and mortgage financing all day long. So thanks again for joining in. This has been the Mortgage Minute. Thanks and have a great day. We'll see you soon. Thank you for tuning in to the Mortgage Minute for a quick, insightful journey into the world of real estate mortgage. Because when it comes to buying a home, every minute counts.